The information provided in this podcast is for general information purposes only and should not be considered as personal advice. Always consult with a qualified professional or expert in the relevant field for personalised advice tailored to your specific situation. You get only one working life. If you don't utilise that, you really are leaving a lot of money on the table here. What do I do and how do I minimise taxes?
Welcome to another episode of The Wealth Guide, sponsored by Ryker Capital.
You're not doing purely for just minimising taxes. It would not make sense for me to go, I have got a tax bill of $50,000, so I'm just going to go spend $100,000 just to get a tax deduction. It's got to have a purpose. It's got to have utility. It's got to have a future growth.
Now, Ray, let's talk tax. My name is Tamara, and I am the practice manager, and I'm very excited to have senior advisor Ray Regmi on the couch with me today.
G'day, Tamara. How are you?
I am very well. How are you today?
Good, thank you.
Now, Ray, let's talk tax. I have not heard one person that has said to me, and I'm wondering if you have, I'm really happy with the level of tax I pay. All good.
No, I've never had anyone say that, Tamara. So let me put it that way. It's, if anyone, I've had more clients going, Ray, what do I do and how do I minimise taxes? That's not only for my company, but also me individually. So I suppose, everyone wants to look at some form of strategy to minimise their taxes.
Absolutely. Everybody. I mean, you do get people wanting to pay their fair share, but look, we'd rather have every last dollar that I can in my pocket so I can build the life that I want as well. Yeah. And I know that, in speaking with you, there are a lot of your focus is definitely on when you're providing financial advice, let's make it tax effective. Yeah. How are we actually increasing the dollars that are going into our clients' pockets? And then you can help clients work with those extra dollars as well. Can you kind of talk about a few of the, tax strategies or your approaches and how you actually turn the dial on that for actual clients?
Look, I think first and foremost with any part of tax strategy, I think important thing to understand or perhaps keep that in mind is you're not doing purely for just minimising taxes. It would not make sense for me to go, I have got a tax bill of $50,000, so I'm just going to go spend $100,000 just to get a tax deduction.
Yep.
It's got to have a purpose. It's got to have utility. It's got to have a future growth. With any kind of tax strategies that you're looking to create or structure personally or for company, it needs to serve a purpose. I think that's the biggest important part. Now, whether you're looking at that in the form of property, whether you're looking at that in the form of contributing into super, tax minimisation strategies using other vehicles, whether it be company or perhaps sole trader. So any form of strategies should have a predefined set goals, ideas, and a structure, and what form of growth you're hoping to achieve out of that tax strategy.
What I'm hearing from you is not just to get a tax deduction and minimize tax for that sake. You really want to understand what you need your money to do for you. Let's do it in the most tax effective way.
Exactly.
There has to be that utility in that goal.
Exactly. I mean, I've seen people just go out, spend $50,000 and they're on a tax bracket of 30%. So they've effectively got $15,000 back, but they've lost that $35,000.
Well, true too. And I know that as well, and maybe we can talk about the difference and dive into one of those. Definitely, as we know, and we've talked about already, if you make a contribution, a salary sacrifice contribution into super, you can save some tax. But really, then if you put it into super, you can't access it. So if the purpose is to build for retirement, makes sense.
Exactly.
But if one of your priorities are something like a pre-retirement goal, maybe that's not the best timing to do that. You look at some other way to do a tax effective outcome for clients.
Exactly.
Is that a good example?
That is a very good example. Okay. But let me put it this way. I'll give an example of the recent case of a client that we've helped recently. So effectively, Michelle and Josh had recently sold their investment property. After what they bought the property for, they've just made a gain of $500,000.
Brilliant.
Right.
Okay.
Now it's a great that you have received that amount of gain. Now
I have to pay tax on that, don't I?
Exactly. So the capital gain tax is looming right there. So effectively with the 50% offset, what they will get is they're accountable then for $250,000 of those taxes, which then gets divided between the two of them. So it's about $125,000 each.
Still a lot of money.
It's still a lot of money. So that $125,000 is their assessable income. On top of that, they're earning a salary of $60,000 each. So now that takes them up to $180,000.
That's high marginal tax rate.
Exactly. For $180,000, they will be paying an approximately, give or take, about $60,000 in taxes.
I'm very glad I'm sitting down. So they wouldn't be happy about that. What can you possibly do?
No, because combinedly, they're up for about $120,000 in taxes.
So that really eats into their hard work and being really smart and really, getting that result. So what do you do about that?
So see, then they've done all the right things. They've bought the right asset. They've done the right structures. But here they are still up for $120,000 in taxes for the hard-earned money they made. But look, I think in their cases particularly, I think what worked out really well, or what happened was, we were able to then make contributions in this super fund.
So this made a lot of sense then.
Exactly.
This strategy.
So in that part of the strategy, it was like either I'm going to pay this money to the ATO, or I'll effectively make contribution my own super and create a tax deduction. Yep. Now, fortunately, unfortunately, I think they haven't made any contribution to super for the past 5 years, because there was sort of in between sole trade and then company. So
it's not great, but they have room to put that money into super is your point then.
Exactly.
Yep.
So what has happened was, over the period of time of this 5 years, they haven't made contribution. They had available to them was $130,000 each.
Okay. Is that having to do with adding up the different yearly caps?
Correct. So what was available to them was the 5 year worth of contributions concessionally, which they hadn't done. Mm-hmm. We were able to compile that all together and go, right, this is what's available to us, which allowed us then to make that $130,000 worth of contribution each under their name and claim that as a tax deduction. Whilst it was taxed at the rate of 15% on the way in, but it still helped them reduce their marginal tax rate. Now, by doing that, I think effectively what happened was their taxes came down to $15,000 per person. So here you were up for $120,000 in tax. Now you're only paying $15,000 each, which was $30,000, which resulted in $110,000 worth of tax savings.
That is tremendous. That is a tremendous advantage of doing that strategy. And really it is. And it's in that environment and it's their money.
Exactly.
You know what I mean? And they're going to be using it for retirement, which is what the super environment is all about. It's really important because I know that a lot of Australians do make money in property and then are looking at, I've made all these great choices, like you said, and I've got a capital gain, because you need to understand when you're exiting a strategy, selling a significant asset, you need to have a tax minimization strategy.
Well, you need to have some form of plan to go, what are you going to do? And achieve it to go, well, how do I help minimize my taxes? Because I've got these gains that I've made for all the hard work and the right decisions that I've made over life, but how do I make sure that I get to keep most of my money?
Because you don't want to do 3 steps forward and then 2 steps back.
Exactly.
Really, if you're going to do that.
And you need to pre-plan that way ahead.
Before you actually are pulling the trigger on it, or facing that tax bill.
Yep.
And then I bet you've had people come to you and they don't have much, because if you've sold the property in a particular tax year, you've got to do something
within that financial
year. Yeah.
And look, we had many of the unfortunate cases where they've just sold property smack bang on the 29th, and there was just a little bit too late because they hadn't even planned it out.
Yeah.
Now all of a sudden they're up for a huge amount of CGT.
Okay, so that is definitely a great example. Is there any other types of strategies?
Yeah, look, I think another one of my favorite was this combination of strategies that we did for a couple of other clients at David and Tara. So David and Tara are lawyers. They both earn, I think from memory, they were earning about $120,000 and $140,000. So they had a significant level of large income as a combined as a family. They've got 2 kids. And the other part, their main goal and priorities was to go, well, we earn a very good amount of income. How do we minimize our taxes? They wanted to have an asset. They wanted to have another investment property, which was a big part of their goals. They had significantly good amount of savings saved up, which was about $240,000, but they wanted to use that as an investment for the kids, but not accumulate any tax liability on that. And they wanted to look at sort of some form of strategies that's going to, in a diversified way, will help them achieve their tax strategies. Okay. So what we were able to do for them was utilize 4 different type of tax strategies, whereby first part of the strategy was to use investment property. So I think their heart was set on buying a new investment property. So we had to sort of then work with his mortgage broker, who then sort of worked with a property advisor at that time, who was able to sort of recommend a very good property which had a good future potential growth, but it was a brand new property, so it really helped them with that negative gearing aspect of it.
Okay.
So then you can claim the depreciation on that property,
I was going to say depreciation. Yes.
Keyword.
Okay. Perfect.
Because they wouldn't have been able to achieve that in an older style property, or not as much.
Not as much.
So it all depends on the type of property that you were looking to buy.
And what you're trying to do, like, to your point, this is the type of property I'm going to buy because I want it to achieve this. So then short-term tax savings, negative gearing.
Yep.
Long term, it has growth potential. So we're looking at capital gains in the future.
Correct.
To achieve the outcome.
Correct.
Okay.
So effectively, you are then spending money to achieve that future potential growth in that property. And because they had done quite a good intensive amount of homework and research, the suburb that they bought in had a significant amount of potential for capital growth. Right.
Yeah.
But they just didn't want to rely on purely on the property aspect of it.
Yep.
So the other part that we looked at was the investment bonds for the kids. So second part of strategy then overlaid that with investment bonds, which means as that savings that they had of $200,000, they didn't have a use of that amount of money for a considerable period of time, but they wanted to save that money purely for kids, which their grandparents had left that for them. We then utilized that in investment bond, and the beauty about the investment bond is when that money is invested, it's taxed internally. So it never attributed to their personal tax income. How significant is this that if the fund's earning about 6.5%, 7%, and that's getting compounded over the period of time for over 10 years, and when it matures after 10 years, they had no tax to pay.
Through that period of time, which is very, very significant. So it really is the diversifying. To your point, you've got property's got a purpose. This is what we're doing with this, and it's tax effective.
Correct.
My money also needs to do this.
Yep.
This is the other element, again, tax effective.
Which was money left to them for their kids, left by their grandparents.
So
which allowed them to sort of build up this good investment bond for their kids. So when they go to university, they've got this significant amount of money there to help them get to that purpose. But the income generated was quite tax effective. Not to say that you're not paying tax, because bonds pay an internal tax rate of corporate tax rate of 30%. So they were taxed internally, but however, it did not attribute it to their personal tax income.
Which can be a problem in the sense that grandparents give you money, but if it's sitting in your name, or how are you going to manage it? Because you're in your high earning years.
Correct.
And it's all of a sudden a tax burden for you. So that's a very, okay.
And if kids are earning also up to a certain part of it, they're also paying a very high marginal tax rate at the same time.
Yeah. So not just having it in the kid's name as well.
Yeah.
Very good. So structures.
So it's just the first part of the structure. Third, with what we did was, given that they had sort of bought out an investment property, they had now debts. We overlay that with the income protection outside. So that income protection policy that they have now taken on, which was to basically cover the income in the event should something happen. They are high income earners. So they've got a significant level of income coming in. Now, if that income was not coming in tomorrow, their lifestyle was going to suffer, because these strategies all depend on it.
Because they didn't have enough passive income at this stage in their lives to replace their income, so they needed that insurance.
They did initially, but now they have a burden of an investment property for the tax part of the strategy.
Okay. Yes.
That savings was now attributed towards the investment property.
So they were relying on their income then. They wanted to make sure if they were sick or they're hurt, they didn't want to affect their lifestyle or their investment strategy.
Exactly.
Right?
And we'll provide for the two kids because they had their private school fees and putting foods on the table, really.
So when you say outside, do you mean so they're paying for that insurance premium out of their cash flow?
Correct. Yes.
As opposed to, because I know you can put that kind of insurance in your superannuation as well.
But for them, it did not make sense to pay for that policy through the super fund. It was more designed to have that policy outside, which means that if whatever the premiums that they had paid were generally tax deductible, and they were able to claim that as a tax deduction. So this was the third part of the strategy that we had a look. And then the fourth part of the strategy was, as their savings had built up over a period of time, because the idea was that whatever savings would have come in or whatever extra money they had, they'd offset the interest on their loan, because they had an offset account. So they would put any amount of extra savings going into their offset account. And in June, they would both make a lump sum contribution of, I think, $10,000, which brought them right up to their cap of 27.5.
Yep.
So as they made this personal contribution, in July, we turned that into a concessional contribution by a form called a notice of intent, which then allowed, because they put this $10,000 money into the super fund, claim that as a tax deduction, and effectively whatever money they got back based on their marginal tax rate went back into their home loan.
Okay, so
let's get our head around that again.
Yeah, I was going to say that's a level of complexity. They own their own business, right?
No, they were both employed as lawyers.
So you can do that if you're both employees as well.
Absolutely,
I did not know that.
Yes. So effectively, what we did was we wanted them to save money throughout the whole course of the year, because the money was coming to their offset account. And what we did right on smack bang on the first week of June, we paid the contribution into the super fund.
Yes.
Let's just say in this instance it was $10,000. We would then claim that as a tax deduction, which then allowed them to tell their accountant going, hey, Mr. Accountant, I put in $10,000 in my super fund. Can I claim this as a tax deduction? Which he then claimed that as a tax deduction based on the marginal tax rate. Let's just say they received $4,000 then each, and that sort of went back into their mortgage.
So what I'm getting here now as a whole, really, when you're looking at any client scenario, there is opportunity to have multiple different
tax structuring,
depending on different parts of the strategy and the purpose overall, different goals for the different areas of how you're investing.
So in their instance, they had $12,000 saving for David. I think Tara was roughly around 14. So it's about $28,000 every year. And you get only one working life. And if you don't utilize that between that period of your working life, you really are missing out or leaving a lot of money on the table here. You
are. So work smart, not hard. Well, work hard too, but work smart and see a smart financial advisor. Somebody who knows his stuff. Ray, thank you very much. That was very insightful.
No problem at all. Tomorrow.